Hi everybody, welcome back. In this video, we're going to continue talking about the money and banking system, and we're going to do a sort of high-level overview of the Federal Reserve System. In the last video, we talked about what money is, what are the functions of money, and how we measure the money supply, and its different measurements based on liquidity. So the Federal Reserve System is in charge of the money supply. And when they change the money supply around, that's called monetary policy. And monetary policy is, in recent history, the primary, not necessary, that's not necessarily true. There's also fiscal policy when Congress passes bills or stimulus packages, which they have been doing a lot recently, post COVID. But monetary policy too. And so monetary policy, the Federal Reserve System regulates the supply of money, and this has historically been a very important component to getting out of recessions. So, if the Federal Reserve is in charge of doing this, we should learn a little bit about what the Federal Reserve is. So, it's a central bank. The Federal Reserve is just the name of the United States central bank. And then other countries around the world have their own central banks. Europe is a little special because it's what's called a monetary union, and they have their own. It's called the European Central Bank. I'm just going to abbreviate that, but Japan has a central bank. Most all governments have a central bank, and so they're usually just called the central bank of Japan or of Chile or something like that. Okay, so it's a central bank overseeing the banking system and regulating the money supply. So the Federal Reserve, which we call generally the Fed. So when people say the Fed, if it's an economist telling you the Fed, we're talking about the central bank. Some people talk about the Feds with an S, generally referring to the government, but the Fed is the Federal Reserve Bank of the United States. It was created in 1914. Before that, there were a whole bunch of bank failures. There were what was also called runs on the bank. So people kind of have, if they have a lack of trust in the banking system, everybody would run to the bank. There would be huge lines. The banks would run out of money, and the banking system and economy would have a lot of big problems. So the Fed was created, and if you've noticed, people don't run to the bank anymore. So during the Great Recession and during in 2007 after the housing crisis and during the COVID pandemic, for example, you didn't have lines of people waiting in the bank trying to get their money out. That's because of the Federal Reserve, also Federal Deposit Insurance Corporation, FDIC, which helps ensure a stable banking system and and helps to prevent these types of bank failures and runs on the bank. So the structure of the Fed is that it's run by this board of governors. There are 7 members of the board of governors, and they're located in Washington, D.C. These people are appointed by the president confirmed by the Senate, and serve 14-year terms. And generally speaking, the Fed is supposed to be apolitical. So, the board of governors, these people, they're not kind of talking about their party. If they have a party, they're not talking about it. They're not making decisions based on politics. They're removed from that in kind of in a large way, much more than say congressmen and women who are more in charge of fiscal policy. So the Fed is supposed to be an apolitical organization to just make sure that the banking system, the prices in the economy are stable and running soundly. We'll talk about, they have this dual mandate of their goals, which we're gonna talk about. So in this board of governors, there is a single person who is the chairman or the chairwoman, and they're the most important of that 7-member group. They're the ones who give speeches. They're kind of the figurehead of the system. The previous president was Janet Yellen, and she was the first ever chairwoman, which is notable. And the current, as of early 2021, the current president, chairman of the Federal Reserve, is Jerome Powell. So he started in February of 2018. Before Janet Yellen was a guy, Ben Bernanke, who sort of oversaw, guiding us through the Great Recession and the financial crisis in 2007 and 8. And most of these chairmen and chairwomen are PhD. Often they were previously academic economists. Jerome Powell actually has a legal background, more so than an economics background. But by and large, most chairmen and chairwomen and other members in the Federal Reserve System, a lot of economists in there. So, moving on. So we have the Board of Governors, which are the 7 people in D.C., and there are 12 regional Federal Reserve banks in different cities across the United States. Each of these banks, they have their own president, and those presidents are going to help make up the Federal Open Market Committee, the FOMC. This committee is in charge of making the monetary policy decisions, and basically that means they're in charge of adjusting the money supply. And we'll talk about that in a second, but they adjust the money supply in order to change the interest rates, and the interest rates help to control inflation and prices in the economy. We'll talk about that in a minute. They also help stimulate the economy to get out of recessions. But this is all done by the Federal Open Market Committee. This committee has 12 members, so the first are always the 7 Board of Governors members. You have 7 of them. Now you have 12 regional Federal Reserve banks left and their presidents. You're always going to have one who is the president of the New York Federal Reserve District. So the president of the New York Fed. That is because at the moment the financial capital of the world is New York City, Wall Street. Because it's such an important financial hub, that president is always a member of the FOMC. So we started with 12, we have 11 left, but it's a 12-member board, so we have 4 more of the remaining 11 regional bank presidents. Regional Fed bank presidents. So those 4 rotate every year. Okay, and so that makes up 12, and these people decide what happens to the money and banking system in our country. Well, at least the money supply and interest rates. So what does this look like? What are they actually doing to make this happen? A few things. And historically, the main thing has been open market operations. There's also something called the discount rate and what are called reserve requirements. So let's talk about each of these really quickly. This is monetary policy tools. I'm just checking my time. Yeah. Okay. So open market operations. This is when the Fed buys and sells U.S. Treasury securities to increase or decrease the money supply. So the Fed buys or sells U.S. Treasury securities to increase, or if they sell, to decrease the money supply. And so again, U.S. Treasury securities are basically loans to the government, but they're owned by all sorts of people. Actually, if you or your parents have any sort of retirement account, especially as people get older and they want less risk than they would have with normal stocks, and they switch to bonds. A lot of bonds held by the public, the general public, are actually U.S. Treasury securities. So when this happens, if they buy U.S. Treasury securities, and that's going to increase the money supply, that's going to decrease or increase, if they sell, what's called the federal funds rate. And the federal funds rate is one of kind of the fundamental interest rates in the economy. It's usually one of the lowest, and if banks need money, they can often borrow from other banks at the federal funds rate. And so these are very low. So when they're at their lowest, they're down around 0%, or maybe even just a 0.25%. So if a bank can get access to money by borrowing at 0.25%, and then they go out and they make a loan for 3.25%, then that bank is going to make the 3.25 minus the 0.25. That's going to be a 3% profit on the loan if they're able to access that money for that cheap. A lot of the money they get is from the depositors. We'll talk about that later. But to just give you a little bit of a picture about what's going on here. So there's the market for money. And really here we're thinking about the treasury securities. But what's happening there is there's a demand for money, and there's a supply of money because it's always fixed at any given point in time. That's gonna be vertical because it's just set. Like the Fed is going to set the money supply at some number X, right? And that's going to be the quantity and the price of money, which the price of money is the interest rate. Technically, you can go buy money, right? If you go to a bank without any money, you can buy money from them. You just have to pay them back, say, next year, but you have to give them a little extra, right? That's going to be like that 3.25%. I can buy money for 3.25%, for example. And so actually, let's start with that. Let's start with that's fine. 3.25%. if that's the equilibrium interest rate, and the Federal Reserve, they want to stimulate the economy. So how do they do that? If we're in a recession or something's going on, they want to stimulate the economy. What happens? They increase the money supply. When they do that, the equilibrium interest rate drops. Let's say it goes down to 2%. So you increase the money supply. The federal funds rate, we'll just say the interest rate in general, drops because the money supply has gone up. When the interest rate drops, what does that mean? Well, it's cheaper to borrow. And when it's cheaper to borrow, people borrow. And what do they use it for? They use it for consumption goods, like a car, right? Or a boat or an RV or something. But they use it for consumption goods. They also use it for a house, which falls under investment. Or companies will borrow and invest in their businesses. And if you recall, GDP from several videos ago, so go back and check that out if you haven't. GDP is equal to C plus I plus G plus net exports. So if consumption goes up or if investment goes up, that means GDP goes up and the economy starts to recover. So that's the general idea behind, actually all of these. So open market operations, discount rate, reserve requirements, all of these monetary policy tools are going to increase the money supply. And when that happens, all of these things follow. Okay, so and I spent a little bit of extra time on open market operations because that one's a little bit more important because it's the one that's been historically the main policy tool. Right now it's down around 0%. So it's actually during COVID and actually during the financial crisis, the federal funds rate dropped so low that they've had to do a little bit of extra unconventional monetary policy, but we'll talk about that later. Quantitative easing and such. The traditional monetary policy tools, open market operations, and the next one is the discount rate. So the discount rate is one of the rates at which banks can borrow money from the Fed. One of the rates at which banks can borrow money from the Fed. Okay, and so again, this one, banks are directly borrowing from the Fed, and so we're actually kind of skipping that first part, and the interest rate is just going down. So banks get cheaper money, they can offer cheaper loans, and cheaper loans means cheaper to borrow, everything else follows. And finally, the reserve requirements. So the reserve requirements dictate how much of a bank's deposits must be held as reserves. So this dictates how much of a bank's deposits must be held as reserves. So banks, they have requirements on, okay, if I give the bank $100, how much of that money are they allowed to lend out to somebody else who wants a loan? I can still go back in the bank and get my $100 anytime, but they're able to use some of that money to provide a loan to somebody else. And the reserve requirements just dictate how much of that is possible. And so if the Fed, if they want to increase the money supply in the economy to help it out, what can they do? They can use open market operations to buy government bonds. So emphasis on buy there. If they sell, it's going to do the opposite. They can decrease the discount rate, or they could decrease reserve requirements. So if they decrease the reserve requirement, that means the bank is allowed to take more of the money that I put on deposit and make more loans. And if there are more loans going out, people are using those loans to buy things, and that's going to help stimulate the economy. So these are the three main ideas. This idea of reserve requirements is a little bit more complicated, and so what I'm going to do in the next video is talk a lot more about that. All right, so that's the Federal Reserve in a nutshell. The structure and the things that the Federal Reserve does. It's what we call monetary policy. And and so these sorts of activities help to stimulate the economy when it's not doing well. All right, in the next video, we'll talk about reserve requirements. I'll see you there. Thanks.